I'm Aaron Rubin, your retirement plan advisor, and I'm really excited to bring you the news about the second quarter of 2014. Turned out to be a pretty good quarter, but you never know what's going to happen in the next one. So let's go ahead, dive in the numbers, and then take a look at the things that we should really think about and perhaps even worry about, and how to control them. Enjoy. As I mentioned before, a pretty good quarter overall. Now, when we see a lot of green arrows, we can be happy about that. Now, when you look at U.S. International, U.S. looks like it outperformed overall slightly. The emerging markets bounced back a little bit. It's had a rough couple of years, and the big winner for this quarter was the U.S. Real Estate Investment Trust. Now, real estate, who knew? But who knows anything, right? That's why we diversify the way that we do, because we don't know which asset class is going to perform better than any other. Now, when we look at the 1 year, the U.S. slightly lags behind the international. We look at the 5 year, the U.S. is ahead of the international, somewhat substantially. And look at the 10 years, it almost looks like a wash with the U.S. slightly outperforming international. Again, this is all cyclical, and we don't know if the next period is going to bring the same thing, but that's why we diversify. And the bonds, up ever so slightly, which is just the way we want our high quality short-term bonds to be. And from a portfolio perspective, again, it was better to be in the stock market. Not surprising. So for the quarter, the stock fund outperformed by 1.1%, and the 25-75 overperformed the 50-50 portfolio by about 1%. And so on and so forth until you get to the bonds, which kind of eked along. Now, if we look at the 1 year, it's even more contrasting, where the 100% stock portfolio returning 24.5%, the 75% stock portfolio 18.8%. Again, in terms of return, very important, but return isn't the only thing that we need to look for when investing in a portfolio. We also need to take a look at the volatility. And when we look at the volatility, indeed, the 100% stock portfolio just moves more than the 75-25, and the 75 moves more than the 50-50. So again, being an investor, being a long-term investor, it's important to know that if you're not able to ride out those bumps, the return numbers essentially do you no good. So if we look at the really long picture of U.S. bull and bear markets represented by the S&P 500 from 1926 to 2014, what we see is that these bull markets, like the ones we're in right now, they're typically a lot longer running than the bear markets, which seem to be relatively short but can be very impactful, like we saw in 2008, which is on the far right-hand side of this graph with that minus 51% return. But again, having two decent corrections or two decent bear markets in a 10-year period of time is not completely unheard of. And having a relatively long run in a bull market is not unheard of either. So what this is to say is that you shouldn't bet your chips based upon where you think we are in a particular cycle, because the truth of the matter is you have no idea how long that cycle is going to last or how intense it's going to be. So with the second quarter in the rearview mirror, let's talk about things that motivate us, specifically fears. Let's talk about things that we can control and how we can control them. How many people go to bed at night and have nightmares about mosquitoes? The truth is, not many. Sharks, however, scare the living daylights out of us. But when you look at the numbers from an objective standpoint, as of which of these two animals you should be most afraid of, the answer is clearly mosquitoes. Mosquitoes kill about 725,000 people a year. Sharks kill about 10 people a year. So in terms of rational fears, one should fear mosquito more. Now, of course, sharks have bigger teeth, more teeth, and sharper teeth, but nevertheless, of things you should worry about in your everyday life, the mosquito is tops. And as investors, what do we really fear? Well, first we fear the market tanking and our investments going to zero. We are concerned about taxes and governments taking things away from us. We're concerned about inflation, about the value of a dollar going down, and we're concerned about making bad decisions ourselves. But really, what we should be concerned about the most is probably the one of those that we're concerned about the least. The problem is, inflation is a near certainty. And there are times where there are deflationary periods, meaning that that the cost of things are going down, but most of the time, the cost of things are going up. Now, what this leads to is a purchasing power issue, where the dollar that we're using today is going to be relatively worth less than the dollar tomorrow because the costs of goods go up over time. So the question becomes, how do we deal with that issue? Purchasing power is really important because what happens to us in retirement is that we tend to become a lot more risk averse. Now, let's say we were to retire in 1967 and not put our money into any income producing asset whatsoever. We just sat on it. Well, 30 years later, in 1997, that $1 million in 1967 would have eroded to $206,000. And that would be a really horrible thing, because you would think you were rich in 67, you'd be able to buy yourself a lot, but you'd be able to buy a fraction of that 30 years later. In 1984, if we had retired, and then through 2014, if we would have had that $1 million, it would have eroded to $433,000. So really, when keeping things in cash with no income producing whatsoever, you're almost guaranteeing yourself a loss. And what about investing that money? Well, if you'd put that money in 1926, that $1 million, into cash, and you let it ride to 2013, you'd have a rate of return of around 3.5%. But due to inflation and a reduction in purchasing power, your real return would have been 0.5%. So again, almost no growth. Bonds, you would have a 5.5% rate of return, but in terms of real dollars, 2.5% rate of return. Again, not great. You look at gold, which always hits the news. A 4.7% rate of return, less than bonds, and as a result, a worse purchasing power. Stocks would return almost 10% over that same period of time, with a real growth of 6.7%. Now, that growth along the way would not be smooth. And if you would have pulled your money out at any particular time, you could have really done yourself some damage. And so with all the risks we are worried about, if we take devastation or the market crashing, again, the market does crash, and it can be pretty scary at times, but that really huge crash is going to completely wipe you out. It's not terribly likely. But again, being in different parts of the globe when you invest is important. And diversification will not guarantee gain, and it will not completely prevent loss. But again, it can help mitigate some of these potential events. Deflation, or the cost of things going down, again, cash and bonds can help out with that. Being diversified, again, also a big help. So confiscation, where government taking things away from you, whether it be a tax or other means. Again, it's important to be geographically diversified there as well. So being international in the markets and U.S. markets and emerging. And then capitulation. So choosing really poor choices in your portfolio can be helped with working with a financial advisor. And of course, diversification does help when you take a look at different asset classes, and having some good returns mixed in with those bad returns can be a good, I guess I'll say, mental help. And inflation, the much more likely of all of those risks, can be helped by being in stocks and being in short-term bonds. Remember, those long-term bonds, as inflation hits, interest rates tend to go up, and as interest rates go up, long-term bonds get hit really hard. And being diversified, also very important. So overall, a pretty good start to the first half of the year. Now, as I said, the second half, I can't tell you what's going to happen. But we know that inflation will continue on, and we should continue to think about what to do about it and make sure that our portfolios are best positioned for the future. Best of success.
Please hang up and try again.